Well, many Australians don't think about a retirement budget until money is going out more than money is coming in. Join us to discuss what you need to consider. Liam Shorte joining us from SONAS Wealth. Liam, welcome back. Good to see you. So I guess the most difficult question when you stop working is just how much money I need to retire. So how do you come up with that plan?
Yeah, one of the problems is when people are working, they don't really budget very well because it's just as long as there's money in the bank account at the end of the month, they don't mind. But when you're coming to make that decision to retire, so it's before retirement, you really need to get a grasp of exactly how much you'll need to give you the comfortable, the comfort to actually make that decision to walk away. So there are a couple of little tools out there that we really like people to use. One's called the ASFA Retirement Standard, and that gives you a budget that's it's worked out with about 600 retirees every 3 months. It's updated, and it gives you some indications of what a single person in for a comfortable lifestyle. So you see it on the screen there. Single person for a comfortable lifestyle will need about 52,300. For a couple, it's about 73,800. Or if you've got a more modest lifestyle where you don't want to travel, or you're not a big spender, then you could look at the modest lifestyle. The good thing about that is if you go onto the ASFA site, retirement standard, you can actually get a really good breakdown into every different category, like hairdressing, utilities, rent, everything like that. You can break it right down. And then we ask people to go to the MoneySmart website. It's the government's free MoneySmart website. Just Google that and Google Budget Planner. And there's a lovely, simple spreadsheet on there that matches this ASFA standard. So people can work out their own spending and compare it to what somebody else, either on a modest lifestyle or a comfortable lifestyle, would need. And that's a great start for actually planning and making that decision to retire.
I guess, Liam, it also goes to that point of you're not simply just drawing down on your savings as such, depending on where your money is in terms of retirement and be it in super, the pension you might be receiving. I mean, you need some income generating assets, do you not?
Yeah, exactly. And what we try and do is find that sweet spot for a lot of people of some income generating assets in their own name, some superannuation that moves into pension phase, and maybe the support of some age pension as well. So if you can get that combination of three nice income pots coming in, it's a lot more comfortable in retirement, and it means your own capital reduces a lot slower. So it's just really important to, we found a real problem with a lot of people is they're afraid to retire because they don't know where the money's going to come from in retirement. But when we sit down with them and show them the combinations of what they'll get maybe from an investment property, their pension and the age pension, it all suddenly comes together for them, and it makes it a much easier decision to make.
Now, there's also, one of the key assets, of course, for many people is actually having the family home. You may decide to downsize, sell the home. What's the best strategy in terms of doing that, particularly with the downsizer contribution? Just explain that to us.
Yeah, look, I just feel there's a bit of a trap there with the downsizer because the government have now made the ability for people to use the downsizer contribution from 55 years of age onwards. Now, already, if somebody wanted to put money into super, they can put 120,000 a year on top of their tax deductible contributions. So 120,000 of ordinary money, or 360 at one time by bringing forward 2 years. And they can do that right up to age 75. So they can get a lot of money into super already. The downsizer contribution, yes, you could use it early on, but what we're finding is people who move around 55 or 60, it's not their last move. They'll often move again after 75 or 80. They'll move into a retirement village or something like that. So But what's happened is if they've already used the downsizer contribution and they're 75, they can no longer put any more money into super. So we are seeing a lot of people now going into their 80s. They use the downsizer too early, and now they're ending up with too much money outside in their own name, and they're paying tax when they don't need to. They could have easily got as a couple, got 600,000 more into super using the downsizer by waiting to use that last rather than first.
All right, so essentially then, best to defer the downsizer as long as you can.
Yeah, especially if you've got time to put in those extra contributions over the years up to age 75.
Now, what about advice in retirement? I gather there are some changes coming regulatory-wise.
Yeah, so the government's trying to bring in a new form of, so we say a limited advisor. The first name they came out with it was a qualified advisor, which really didn't make sense because it's somebody who's not fully qualified. It's somebody who's limited in the advice they can give, and they'll be staff of industry funds, retail funds, insurance companies, and they'll be allowed to give very limited, specific advice on things like making a contribution or moving into pension phase. But one of the problems we have is there's already very few advisors in the country. The number's down to about 15,000. These companies are going to have to try and train their staff. And honestly, I believe if the staff are trained and they're good, they'll end up leaving to become full advisors. So we need to fill the gap. There's so many people over the next 10 years moving into retirement that we need to consider the alternatives. There are another class of people out there that are almost perfectly positioned to help their clients, and that's accountants. Now, at the moment, the system is in such a way that it just almost makes it impossible for them to give limited advice. But I feel that this is an opportunity now for the government, while they bring in this new class of advisor, also adapt that class of advisor to bring the accountants into the fold once again, because often they're the most trusted advisor that clients have. And as a financial planner, yes, it's letting them step into my area, but I think it's needed going forward. And as long as they do some basic education and follow guidelines, then they should be allowed to do that simple advice.
Well, it would make sense, wouldn't it, given your accountant presumably would know your financial position better than anyone else. So are you talking about perhaps a sort of para-advisor as such?
Yeah, just on specific areas, because look, there is a lot of things as financial planners we do in terms of estate planning, super splitting. There are a lot of strategies that are more complex, but we need somebody in there for the basic advice for the mum and dads who they just want to know, should I be going into pension phase? Should I be putting a little bit more money into super every year? And their accountant is the one who can tell them, what the tax deduction difference would be for them. So it just makes sense to sort of, let's turn around now and embrace the accounting people as part of this qualified advice service.
Now, Liam, another issue aside from, well, I guess it ties into this issue of how much money you need in retirement is the unknown. How long you're actually going to live for. What do you need to consider? How do you work that out?
Yeah, so look, at the moment, as advisors, we just work with the actuarial tables. So the average female will die at 87, the average male at 84, or if a couple is 65 currently, one of them is likely to live till 92. So that's sort of what we're working off, but it doesn't take anything into consideration. But thankfully now what's coming out, some of the actuaries are coming out with these tools where you can put in more detail about yourself, more detail about your work history and whether it was heavy labor or whether it was at a desk. You can put some of your health conditions, you can put all those details in, and it'll actually give you a more certainty around how long you should be planning for as far as your life expectancy. And it might say something like you need to be planning to 92 for 50% confirmation that you'll have enough money to live on. Or if it shows that you're going to have a lot of longevity, they might say, look, you need to be planning till 97. So it's individualizing it. So one of the tools that's come out is a company called Optimum Pensions, and it's called a lifespan calculator. And I've just loved playing it with clients over the last couple of months, and it's made a difference because I've had clients who are in that 60 to 65 mark, reluctant to retire, and then they put it in there and it comes back and it goes, look, you've got health conditions, you've got things, and it helps us start the conversation about, let's not wait to retire. Let's make sure you retire early, you've got enough money, and start enjoying life so that you don't leave it too late to enjoy retirement.